All right, welcome back to Robinhood Stock Market Watch List group meeting. My name is Carlos, and today is Sunday the 9th, 2022. And we're going to go over kind of our live meeting that we usually do every weekend. If anyone has any questions, feel free to unmute your mic, and that way you can talk, and feel free to bring anything to the table. But like we usually do, we always like to look ahead and plan and see what kind of activity it looks like. Especially with going over like a bunch of news. It seems like most of the news, the weekend news, has primarily been focused on Russia, not so much the North Korea, but these two things really play a big part with the weekend news going into the next trading day. So there's definitely a lot more bearish news than there is bullish news, which is one of the little pieces of the puzzles that we need to put together as we're trying to anticipate what Monday is going to be like. But a lot of times we can also anticipate what Monday is going to look like by looking at some options activity. And so one way to do that is in a couple different ways here. Typically we use barchart.com to kind of see what activity is going on. And if you're not familiar with stock options, there's some pretty basic things, and there's some pretty advanced things to know. But a call is betting a stock goes up, or a put is betting against a stock, betting it goes down. So with the options area here, most active options, we kind of have a total summary of sorted out by the options volume, which is the current day's trading activity. And so, but we do have a call and put ratio, so it looks like the majority going into the weekend, because this is last Friday's activity, is almost 50-50. Now, some of them may be quite a bit different, but we can also look at the ETFs as well as the stocks. ETFs have a lot more volume activity, and so, but we can see that the ETFs, traders and investors are more bearish going into the weekend, but there's going to be a lot of day trading and swing trading in here. So a great way to kind of decipher the two is to go into the options volume leaders here on the left side. And so right now it's still currently sorted out by options volume, but it's important that we also pay attention to the expiration and the DTE, which is the number of days until the option expires. And so right now, the ones with the numbers are the most currently highly active individual stock options, with the calls and puts. And so we can see that right now, the two most active individual calls and puts are Vail, and with two different strike prices, one at a $15, one at a $16, which we can kind of look more, but we see that the open interest is really high. The volume is below that, and so this most likely could be people dumping it. They're getting rid of it. The strategy is no longer valid. One way to look if this is unusual activity, if the roles was reverse. For example, we have this AMD. AMD was drastically down. It got its butt kicked last Friday, but right now we have a highly unusual activity with this one, a $63 call strike price that expires this coming Friday, the 14th, and it had an open interest of only 246, and now a very high amount of interest of 83,000 in options volume. So this is telling us this is pure buying activity. I mean, this is just a lot of buying activity versus this one where the volume is less than the open interest. This we don't know if this is exactly buying activity, selling activity, could be a little blend of both. But what we're ultimately looking for is this scenario. So that way we can buy into it maybe even sometime before close And one of the other things a lot of investors say is always follow the money. And so and so this is one of the highly active individual calls and puts out of all these. So this is a great area to kind of look at, what activity is going on here. We have a couple of the Kanos here, a $10 and a $9 call. One's already in the money, the other one's not. Different strike prices, but we can see that at least the $10 call strike price, we can see that the volume has well exceeded over the open interest. However, the other one has not. So you can kind of see how maybe the ones that were holding the $9 call strike price maybe sold and then bought into the $10 one because it was already in the money. So that way they can get into this absolutely believing that it's going to keep going. And so that's kind of the transition that we're seeing just by looking at these numbers here. So keep going down, avoid the zeros, remember. So we have a Tesla put here. Tesla got, Tesla was just at $300 seems like just the other day, and then boom, now we're right at the almost $220 area. And so, but we can see that there's a lot of buying activity on this one going into this coming week as well. There's another veil, but now we have a put strike price. Remember, it looks like they dumped this one. Now they're buying puts on veil. We got a $13 put right here that expires Friday, October 28th, and it only had an open interest of 1,200 and now 45,000. That's a huge amount, but you can obviously see that a lot of them had maybe secured their gains, and some of them like riding the wave down and profiting a little bit that way. And so yeah, good activity here. And so another way we can look at this is looking at the individual active ETFs. And so that way we can see, because a lot of this is going to be shorter term than some of the stocks. And so but again, avoid the zeros. So looking at SPY, so again these types of investors are kind of looking more into what Monday is going to be like. And so so by looking at the first one here, we have a $360 put strike price on SPY. We have a $365 one that's already in the money. And so we can see that it had very little open interest, and now it's got a lot of volume activity. So it's got a lot more interest because people believe, or not just believe, but they're betting that Monday is going to be very bearish, at least early in the morning. Then the third one is another SPY put. We have a $362 one, and then the fourth one is $363 one, and with a lot more volume that exceeds the open interest. So there's four puts right there. Then we have an EFA put right here with, well, the volume's just slightly under open interest, so but it's almost even there. Say that again. Can you repeat that? Anyways, I wasn't able to hear you. When you get a moment.
There's no sound.
Oh, okay. That's weird. Yeah, okay. Hopefully you can hear me now. I don't know what happened there. Must be some kind of glitch. So anyways, thanks for letting me know. If that happens again, definitely let me know. So continuing down with the ETFs, we can see that there was a lot of SPY puts activity here going into Monday. And but yeah, EFA looks like there's another put there. Then we got another SPY put here, 364. And until we get to the very bottom of the page, that's when we start seeing a few calls. These may be just a few that are wanting to straddle, just in case, but the majority of them, it looks like 80% are bearish going into Monday, which is pretty. That's a high percentage, and but this information it updates every 15 minutes when the market's live, and so we can easily come here, refresh. and take a look at this stuff. Another cool trick about utilizing this free website is when we go to the options volume leaders, it automatically sorts it out by options volume. But the trick is, if we click on open interest, it'll sort it out by the open interest. But what we want to do is click the refresh button, and it'll refresh the entire system under the open interest. And so this will show a much longer expiration date. For those that maybe are extremely busy and just don't have time to look at the screen all day or really any time of the day, I mean, I know that there's quite a bit of you that just work a lot and are missing a lot of opportunities. Well, these high open interest opportunities are usually those that just can't really look at the screen a lot. So this is a great way to kind of see what those guys are doing. And so again, we were just talking about Vail. It looks like this was one that they just recently dumped, and so the next one going into tomorrow, we can see that Twitter has a lot of open interest, and we know what's going on with Twitter and Elon Musk and Tesla and all this stuff, and it's just creating a lot of volatility. And so right now we can see that Twitter is right around $49, but we have a $50 and a $55 call strike price that both expire next January the 20th. That expires approximately 104 days. And so you can see that there's a lot of people that are betting on that, as well as straddles, because we have a Twitter put strike price right here, just in case if something doesn't work out. I mean, anything can happen. I mean, Murphy's Law, if anything can happen, it will happen, okay? And that's why these guys are placing an insurance on there, just in case if things go south, that they'll be protected, at least somewhat. But it looks like the majority, I'd say 66% are bullish, or 33% are bearish. So with that ratio, we can easily straddle in that ratio. So that would look good. That's what looks like the majority of the investors are doing. Again, what do the most of the pro traders and investors say is always follow the money. And so Twitter is going to be huge going further into this month. We should be seeing news regularly every week as we approach Elon Musk and Twitter's court date and their final resolution. So Bed Bath & Beyond, I think, is slowly becoming one of our latest manipulated stocks, as it has done very bad lately. Not just because of the company, but with the way the market's been as well. But it lost its CFO that committed suicide about a month or two ago, and they've had to close a bunch of stores. But sometimes bad news is good news. When you close a bunch of stores down, the company can become more profitable. And so when a company is more profitable, their stock value goes up. Now, Bed Bath & Beyond's, usually their prime time of the year is during the fourth quarter, during the holiday season, when there's the Christmas season, a lot of shopping, Black Fridays, when we got whatever, and weddings and so a lot of people usually shop during that time, and Bed Bath & Beyond will typically have some great earnings for the fourth quarter. And so I would anticipate that I don't know if it's going to get to 80. That just seems like this is kind of like a manipulation alert kind of thing, but it's definitely something we want to keep on our watch list, because there's some reason why people are buying this and holding. And so even if you decide to buy shares, you don't have to buy calls. You buy a share. If it's $5, gets to 10, that's you're just doubled your gain. If it goes to $20, I mean, even if it got even half of that, $40, that is a humongous gain in a very short period of time. Just right after Christmas, buy on rumor, sell on news, and get in, get out, and this could be a very, very quick, easy profit in a short period of time. So, but like I said, there's a lot of interest on it right now that's accumulating every day. And so next one is Nikola. Nikola has been having, all the electric vehicles are having some issues. Like everything's been having issues, but there's a lot of because a lot of these, like Nikola has had some issues in the past, but they're going to and have been getting through them, and will actually be coming out with a product hopefully sooner than later. But when they do, this thing's going to skyrocket. They have some great concepts. They just have some hoops they got to jump through, but it looks like investors are very optimistic with it. And so we do have a $5 call strike price. And I've seen this before, with other things like NEO, for example. And now Nikola is an all-American company, where NEO is a Chinese company. But we were trading it when it came out as an IPO. We were trading it when it was $3, $2 a share. And it was a no-brainer that eventually it was going to skyrocket, and it did. Finally, once it kicked in, once we got out of our bear season, went into our bull season, it kicked in, went from $3 to $6, $10, and $20, went all the way up to $60. That is a substantial amount of gains. But all the electric vehicle companies are starting to kind of come down. But the difference between now and then is that the electric vehicle, there's a lot more electric vehicles out there now, and companies, and so the market's kind of flooding itself a little bit. And so, but still, this one is one of probably the next one in line to be the next runner. And so again, investors are betting on that. It's not, you can't take someone's word for it or whatever. Numbers don't lie. And these are the numbers. These are the actual statistics and stuff. This is where people are putting their money on. And so that is something that we can kind of be more certain on. And so Meta, so we got Facebook here. This is really, really interesting, and it's been accumulating more. So Facebook, which is currently at around $133 a share, not that long ago, it was at $300 something. Facebook, Mark Zuckerberg, they've really gotten their butts kicked lately, but they're working on so much behind the curtains right now. They're on the verge of coming out with a whole new and improved Oculus virtual reality thing. There's so many more things that they're getting ready to open up in the Facebook world, in the application and whatnot. So they are working on some things that we could easily see, especially during the next bull season, where it can easily at least double itself. But here in a few years, and then again, look at this though. Another thing to think about is the election. This whole social media thing is going to be huge, because when it comes to the election, a lot of people are going to just dive into it and try to promote different sides and things and whatnot. But then we're going to have a lot of people that are going to unplug or switch. We're going to have a lot of people that may switch into the whole the Donald Trump's truth application, which if you don't have that, I would definitely recommend getting that, at least for a side thing, because eventually we could see it really take off. And so as well as its stock, as we get closer to the election. And so, but we have a lot of people that are betting that Facebook is going to reach $420, at least pretty close to it, by 2024. And so that's very, very that could be very, very likely, because like I said, it wasn't that long ago where Facebook was up there. And so and then Ford Motor Company, right now we have a $15 call. It's definitely a $15 call, even or a $20 stock all day long. Before Russia invaded Ukraine, Ford had just touched $25 a share. They're going through some shortages and whatnot, but they're mass producing the F-150 Lightning. They're not, they're trying to do that, trying to get access to batteries and other things. But they're building, several new factories and stuff. That way they can really, get more dialed into the electric vehicle mass producing process. But it's definitely something. And they used to pay a dividend. I don't know if they still pay a dividend now, but not only are you holding on to something that's appreciating, but you'd be getting paid every 3 months. And so, but we can definitely see that this has been, slowly accumulating it as well. Then we have Apple puts. So, especially if you see any puts and you're just looking to buy shares, you definitely want to avoid the puts. Focus on the calls. If there's straddling activity where you do see kind of both, then maybe you want to avoid buying shares, because straddling, which is a great, wonderful thing, because most investors believe you can only bet one direction, which is false. You can bet both directions, and that's the beauty of straddling. You can bet a stock goes up and down. I know that may sound conflicting. Why would a person bet a stock goes down and up at the same time? Well, let me show you here. So I also use another website called, it's the NASDAQ website. There's an options area that I like going to, but let's use AMD as an example, because a lot of people like trading the tech companies, whether it be Apple, Amazon, Tesla, AMD, or Nvidia, which are the top 5 most traded stock options. And so now AMD, which was significantly down last Friday, due to the fact how our government is absolutely demanding that we do not share or provide China with our advanced semiconductors and the technology. And because we just do not want to further allow them to grow using our technology, or to use our technology for their military advantage. And so that's why we're in this little political issue until China can either implement more of our regulations, or to also try to cooperate more with the world on de-escalating the issue with Ukraine and Russia. And so, however, this move is hurting both economies, and so that's why semiconductors are greatly down. And so, but let's say, so again, straddling, you can only lose what you have in one hand, but your gains in the other hand are potentially unlimited. So let's say if you have an even amount in both sides. I'm just going to use round numbers. You have $1,000 on calls, and you have $1,000 on puts. Your calls, you basically would have just lost pretty much all of it, 99% or 83%, 74%, all depends on what the expiration date was. Now, if you just lost pretty much, let's say worst case scenario, you just lost 100%. You just lost $1,000 on one side. Now look at the other side. You just gained, a 7,900 or 2,900, 6,400, 700%, 9,000%, 13,000%. That is absolutely substantial, and what it does, it washes out your loss on the other side, and it puts you ahead, way ahead in that scenario. Now, this doesn't happen that often. That's substantial. A lot of times, what we'll see is we may lose maybe 50%, 70%, and then maybe gain 80%, 120%, 200%. 300%. It just depends. But the more the more volatile the day is, the more that's going to be in our favor. Now it does not matter whether the day surges straight up or plunges straight down. It's a win-win for us either way. But it's important that we kind of follow certain rules and certain guidelines, which I'll kind of share with you here. I'm going to go to our. Occasionally, what I'll do is I'll post it in our learning center. Someone's trying to share a video or trying to experiment with this stuff here. So, anyways, with the learning center here, I do post a lot of stuff, but occasionally I'll try to remind you guys on some of my basic straddling rules. And so, and I always copy and paste it because, you know, it's just something to kind of remind ourselves, you know, out of sight, out of mind, you know. So straddling is easy with a few simple rules in place. Like rule number 1, always straddle heavy on the top 5 stock options. So the top 5 stock options, which are right here. We go to barchart.com. We go to options, most active options.
Your screen is off.
Okay, let's go here. It's getting a little glitchy lately. There we go. Okay, so if my screen is off, you'll have to go back in your app and click on it. That way you can kind of see what's going on. I apologize for the glitches. This is in a beta stage, so we're actually you know, testing it. It's not this, you know, live meeting stuff using Facebook, which is similar to Zoom, is not available yet to other groups. So we're very fortunate that we have this nice capability. That way we can kind of test it out. That way it can be used in other groups, hopefully eventually sooner than later. But so the most active options, you know, when it comes to straddling, you know, we can also go to you know, the straddling part here to kind of maybe look for, you know, unusual activity on straddling, but also, like I said, the top 5 is our primaries. These are the ones that we usually want to go in heavy the most. And when we're normally looking at this page, we normally see what's here and what's not normally on here. So when we're looking at regularly, we know that we see Tesla, Apple, AMD, Amazon, and Nvidia. But Twitter is starting to kind of trickle up there now because of, you know, the you know, news that's starting to become active with it. And so, but when it comes to the question, which stock should I straddle? Well, you go here and this is your answers. It tells you which ones to kind of go, and we can kind of look at the call and put ratio to determine how much calls should I go in. So like AMD, right before you know, we want to figure out what our ratio is going to be, we can maybe go 60% AMD, maybe 40% puts. And so this is a great way to kind of, you know, look at this kind of statistics. And so the other rules with the straddling, not so much the rules, but kind of our nice guidelines, if I can find it here. So rule number 2 says strike price always at the share price. So always be at the money, pretty much, because the further away that we are from the money or the share price, the more time decay that we're going to experience. And we don't want that. You know, we want, you know, the least amount of time depreciation, but we don't want to spend a fortune on it too, as if we were buying in the money. So we can buy right around the money as long as it's you know, feasible to get to it, like within 1%. If we're away from the money more than 1%, the system may not think, or investors may not think, that it may reach that. And so that's when you'll experience more a time depreciation, even if the stock isn't, you know, moving. And so rule number 3 says always the soonest expiration date for the most volatility. You know, a lot of people want to pick an expiration date, you know, a month from now, which, you know, is fine maybe if you're picking one direction. But when it comes to straddling, you want the soonest expiration date because you want the most volatility. You want to be able to lose 100% on one side and gain 1,000% on the other side. You know, we want that kind of volatility because now you just gain, you know, hundreds of percent. And so and that's what we want, you know. And it also helps if we know going into the next day that it's going to be volatile, especially with the, you know, very strong volatile or major economic reports or government meetings or whatnot. So rule number 4 says buy straddles 5 minutes before close to sell the next morning within the first hour. So basically the first hour and the last hour are the most volatile, most active times of the day, because you have opening, you have a lot of people that are trading and repositioning, and then the last hour is when we have a lot of people that are also repositioning. And so buying and selling. So that's where we're seeing a lot of volatility during this time. But during the middle of the day, where things usually kind of mellow out, is when we're going to experience the most time depreciation for any call or put. And so and to try to avoid that, it's recommended just to buy 5 to maybe 10 minutes before close, buy our calls and puts, and then holding it through the next day, and then trading it within the first hour. We can sell it at the same time, or we can sell it at different times. That way we can try to maximize our gains on one side and minimize our losses on the other side. Sometimes when the day opens up maybe red, and then shortly as it opens afterwards it turns green. So sometimes we can sell our puts, secure our gains, hold our calls, and then if it recovers into the green, it can turn that negative into a positive. So now we can gain from both ends, and that's the beauty of selling at different times. But it's recommended to utilize moving averages. That way it provides you your buying and selling signals. Without those, we would be trading blindly. And without it, that's where I would recommend just sell all of it, within the first hour. If we're past, or if we're right at that first hour, or even past, and there's still nothing, or if you're at a wash, just sell it. It's kind of like fleeing a fight so you can live the fight another day, kind of thing. And so the idea is just to get out, reposition it right before close, and then try again the next day, and you'll be able to save yourself a time decay. And so and that way you just repeat the process. And so the next one here says rule number 5: avoid earnings and splits. And the reason why that is because earnings and splits, when holding stock options, even if you're straddling, it can be crushed. It's called IV crush, or implied volatility crush. And it happens because there's some kind of change in the system, or with analytics or something that greatly depreciates both calls and puts, whether the earnings has moved at all, a little bit, or maybe it's at 0%. You could lose 50% on both the calls and puts. So just avoid earnings and splits. And then rule number 5: avoid straddling through the middle of the day to minimize the time depreciation, which is the other thing that we talked about. And so going back to the AMD, and then once you have the NASDAQ website bookmarked, or you can always change the ticker in the URL address to anything else. That way you don't have to go digging into other things and whatnot. But most of these look like they're all pretty much expired. Very little movement on wait, hold on here. There we go. So we have most active calls, puts right here, and then we can see how Apple has a $142 put strike price that is up 442%, which is a lot. So that's why I always say you can only lose what you have in one hand, but your gains in the other hand are potentially unlimited. And so it's just huge. But anything else other than the top 5 should be considered more or less as a lottery play, because something that we're not used to trading, or we may not be sure exactly what the time depreciation is, or maybe what's going on. But we could also look at what kind of unusual straddling activity there is by clicking on the straddling section of the barchart.com website. Now, when we're looking at the straddling, the 4 straddling and strangling pages, we're looking for multiple of the same stock, because that just shows more activity with that. For example, there's Apple. As we go down the list, there's a second one, there's a third one, and there's a fourth one. So there's 4 Apple straddles going on on this page. We just want to start from the top, work our way down, see if there's any multiple of the same ones. And so there's I think there's 2 NVIDIAs, but so far Apple has dominated this page the most. So then we go to the second straddle page, click off of that there, and then see if there's anything else. Starting from the top of the page, working our way down, and I don't really see multiple of anything. So then we'll go to the Strangle. Now the Straddle and the Strangle have the same concept, where both of them you're betting a stock goes up and a stock goes down. But the difference between the two is that the Straddle is the same strike price, where the Strangle are separate strike prices. Maybe the price is $5, maybe the call is $5 higher and the put is $5 lower. And so that is one way to do it. Again, as long as it's within the vicinity of the share price, that's fine. It doesn't always have to be the same strike price, but as long as it's within the realm, that's it. But you just don't want to go too far out, because otherwise the system won't think that it can get there, and it'll just decay. And so starting with the top of the list, and then we have AMC. There's a couple. There's a third one there. AMC or GameStop is one of the ones that we consider a manipulated stock, and that should be one of our rules, is to try to avoid manipulated stocks. And so because they usually tend to have a lot of time depreciation, and that's one of the things we're trying to avoid. And so then going down the list, there's a Twitter, but I only see one. There's a Tilray. I did see a Tilray in some of the other pages, but I just see the one on here. There's a GameStop that we're just talking about. Going down the list, don't really see a whole lot of the same ones, other than the Apple from the first page. Let's see. On the fourth page here, we're not seeing a whole lot of multiple things, so that's kind of a great way to really look into what we need to do to plan for our straddling, because I highly recommend straddling, because it saves us all the time. Rather than betting one direction. I had this guy many years ago tell me, once you think you have the stock market figured out is when the stock market has you figured out. And is absolutely right. And the only way to try to cover our bases is by straddling, by betting both directions. And we can utilize both directions. And it's just best just to start and just to master it if you haven't already. And so let's go into our economic reports. So let's figure out what this week is going to look like. And we use investing.com website for this. And so we talked a little bit about Monday, and with what activity we see, it looks at least in the morning it could look very bearish. But we could close in the green, but to be determined. And the other thing too, a lot of people are kind of confused that, because I think Monday is a holiday, Columbus Day. A lot of people were like, wondering if it was going to be closed or not. I highly recommend every trader and investor must have a calendar, a stock market calendar. And the best one that I've ever found was the NASDAQ trading calendar. And you just go to Google, type in NASDAQ trading calendar 2022, and you should find a PDF file on that. You can easily print it out. They come out with it every year, so make sure you have it on hand, and it tells you exactly when the holidays are and what everything happens through the stock market. So being in October, there are no closed holidays for the stock market. So we're good. So we got several 5-day trading days this month, but then going into November, we have we do have the holiday closed on for Thanksgiving, November Thursday the 24th, and then more in December and whatnot. So but yeah, so there's only really 2 holidays left in the year that are where the market will be closed for it. So we're good there, but like I said, this is very important. If you're trading, this is definitely something that you're always going to want on hand. And so Monday will be open, and it's going to be very, very volatile with a lot of the news and a lot of things that are going on. But then Tuesday doesn't look like anything. Tuesday could be, as long as they're not really selling fear. Tuesday could be a very a green day, because there's not a whole lot of there's no major economic reports. So and then Wednesday, we have the PPI report for the month-over-month of September. And so, but this forecast is expected to be a little higher than previous, which is bullish. And it's also important to know the times of these in your time zone based on what you're looking at, whether you're on the website or the investing.com app. And so, but if you're not sure what these reports are, you can click on them. They will tell you what they are and how it'll affect things. And so the PPI report, which is the Producer Price Index, measures the change in the price of goods sold by manufacturers, is a leading indicator of consumer price inflation, which accounts for the majority of the overall inflation. So a higher than expected reading should be taken as a positive or bullish for the US dollar or the stock market, while a lower than expected reading should be taken as a negative or bearish for the US dollar or the stock market. And so as we can see that we have a positive forecast, and a majority of the characteristics focus on the forecast. So even if the forecast ended up, if the actual results was the opposite of the forecast, for some reason the reaction still is if the forecast was the actual report. So it's just very bizarre, how that works, but that's just the name of the game, and that's just how things work. And so that's why it's important we always focus on the forecast and compare it with the previous. It lets us know which direction the characteristics will most likely be, whether it be bullish or bearish. So this is telling us Wednesday morning looks like it should be bullish, so we should be opening in the green. So Tuesday, hopefully we should be green. Wednesday, hopefully we're in the green, and then at least in the morning. And then they're going to talk a little more about the short-term energy outlook, and then they're going to have their FOMC meetings talking about inflation and interest rate hikes and whatnot. And so the rumor is that they're still interested in doing another a 0.75% interest rate hike in November. And so this is easily cause a lot of volatility. And so we'll just have to kind of see what happens, but it looks like it's going to be closer towards the evening, towards power hour. And then Thursday morning, we have 4 economic reports that are scheduled to be released 1 hour before the stock market opens. So Thursday morning is going to be probably one of the most volatile mornings out of the week, next to Friday. And so these are great. These are going to be great straddling days, because we want massive volatility in the morning during pre-market. We want the morning to open up, whether it be up 3% or down 3% or 5% or whatever, in either direction. And so we have the core CPI for the month-over-month, for the month of September, is forecast to be a little lower. 0.5, where the previous was 0.6. So this is showing a little bit of a decline in growth. And then we have the same thing, but for the year-over-year, 8.1%. So a little decline there. And then we have the CPI month-over-month report for the month of September at 0.2. Where it was previously at 0.1%. And so there could be some mixed things. So we have things that are lower, some one thing that's higher. Some people are I think kind of mixed, because when we're looking at these reports, it basically says that a higher than expected reading should be taken as a positive or bullish for the US dollar, while a lower than expected reading should be taken as a negative or bearish for the US dollar. But in some cases, less is more, because if it becomes to be less, then that means that the inflation may be coming down, and that may lead investors to kind of begin to see the light at the end of the tunnel. So this may have the opposite effect. This could actually provide bullish characteristics rather than bearish characteristics. So to be determined overall, but we'll have to really, keep a close watch on it. But like you said, we need to straddle it regardless. And I would, and when we're following the money, most likely when we're looking at the overall puts and calls ratio, Wednesday before close, most likely it's going to be 50-50. And so that should be our trading plan going into the week. And again, always, plan our trades and trade our plan. And so the initial jobless claims, this is our unemployment report, is expected to become a little higher, 225,000, where the previous report was 219,000. Now before that, I think it was 195,000 or something like that. It was pretty low. But what the government and the investors, I believe, are wanting to see is they want to start seeing this come up, because they're trying to push a recession or a depression and whatnot. And so typically when this number is up, that should be bearish. But if it comes up, then that means that this whole inflation thing or lowering the inflation is starting to work by increasing interest rates. The higher the interest rates are, we should start seeing more layoffs and this and that, and the unemployment should come up, and these should start coming down and whatnot. So that means that we should be finally over the hump to where maybe we can start doing not so much interest rate easing, but start to cool down on interest rate hikes going into 2023. Because there's no schedule for the interest rate hikes yet, at least not from what I've found. All I can see is what's scheduled so far for the remaining of this year, which will be in November and December. And so, but we could be at this time where the results could provide the opposite effect. So just know that, and we've just got to straddle 50%. And then the crude oil inventories, there's no forecast yet, but that will change. It could change either maybe later on this evening, or it could also change, or it will definitely change tomorrow morning during pre-market. So that way we can kind of have a forecast of if they're bearish or bullish on it. Now normally when we see some pretty big swings, this one was down last week, we should see it up, which would be in that case it would be bearish, because if it's up, then that means not as many people are driving now. I mean, gas prices are up substantially now, and it's the same thing with oil. Oil went up last week like 10% or more. I think the week before last, oil was like $75 a barrel. Now it's like right around $92, $93, $94 a barrel. So less and less people are going to be driving, so the crude oil inventories are definitely going to be going up, and that's going to be bearish for the next several weeks, I would anticipate. But then we're going to start seeing those every 2 week cycles where 1 week it's down significantly, next week it's up significantly, because most Americans get paid every 2 weeks, and so they'll go to their favorite gas station, fill up, try to get it to last for a couple of weeks, and then fill up again on their next payday. So that's the cycle that we're going to begin to start seeing as the gas prices begin to start catching up with the oil prices. So then going into Friday, we have the core retail sales month over month of September and retail sales. Both of these are scheduled to be released 1 hour before the stock market opens, and but we can see that the core retail sales are also expected to be down negative 0.1%. But maybe a little better than the other one. So there could be a little bit of slowdown, but also going into the holiday seasons, we could anticipate that this could start kind of coming up. Retail sales, went up 0.2%, but still lower than previous. But like I said, it could just be a weird transition, but so it's going to be a very, very strange week. But there's a little bit more info under our featured areas. I always post all kinds of stuff. This is where we can go to to refer to a lot of the things that I bookmark, but this is the one of the things you guys posted earlier that I saved on here. But you know, Amazon's going to be a pretty big one, I think, this week, because Amazon, you can see the option trading volume is elevated due to the company's Prime Early Access sales event taking place from October 11th to October 12th. The event is ostensibly intended to fire up consumers who are reeling from inflation ahead of the holidays, and also blunt the impact of similar sales events being held by competitors like Target or Kohl's and Walmart. However, there are reasons to be concerned that the Amazon could dull the luster of its main summer sale by holding too many similar doorbuster sales. It could also mask the slowdown of its e-commerce operations that are experiencing. Expect a price movement around 5.5% by the 14th weekly expiration. So so Amazon is, there's going to be some news on that one. There's definitely some other ones you guys can kind of take a look at. But Wednesday, it looks like there's two federal things going on. The first one is this high impact news event. Holding positions and or opening any new positions during this time can be risky. When it comes to straddling, bring it on. And so at 8:30 in the morning, so 1 hour before the stock market opens, expected to show about, it says, a 0.1 month-over-month drop after stripping out food and energy costs. So these are pretty much the economic reports that we kind of went over, the PPI report. There's another one right here. Which one is this one? FOMC. The meeting that we're talking about will be released, covering last month's meeting with which the Fed officials raised the fund rate target by about another 0.75%. For the third time, and detailed their rate forecast in the summary of the economic projections. The minutes are expected to reinforce that the Fed remains committed to seeing inflation back to 0% over time, although the whatever that is, over how many members view the path for economic growth and unemployment rates will be closely watched. So Wednesday, like I said, a lot of volatility, as well as Thursday, as we're just looking at the scheduled economic reports. But it also says the Bank of America analysts forecast a decline in the year-over-year inflation to 8.1% from the 8.3% in August, while a modest acceleration in monthly headline CPI is anticipated to reflect a slower decline in energy prices. Negative 3.5% month over month, continued elevated food inflation up 0.7%, and strong core inflation up 0.4%. The analysts also think that the core goods inflation will advance by 0.2%, and core services will raise by 0.5%, while rent prices have moderated. That isn't expected to impact the CPI print this month. So other volatile ones, I mean, there's going to be some really massive earnings, because we're just kicking into gear with a fresh new earnings season. So Delta Airlines is going to be some pretty big earnings this week, as well as the Taiwan Semiconductors. Now, especially as we were talking about earlier today, with the semiconductors having an issue with our economy and being able to now sell it to China, that is a massive drop in sales and revenue. And so, but they're sacrificing that for good reasons. But we could easily see more volatility with the semiconductor segment. And so, but it's basically, we're going to see a lot of financial earnings coming up this week, and so I do have our top 10 analysis right here. So we'll start with the top one here. So basically, this is our calendar, our schedule for the most anticipated release earnings this week, and so this is all from Earnings Whisper. And so the most anticipated one is going to be JP Morgan and Chase, Pepsi, and then Taiwan Semiconductor, Delta Airlines, Morgan Stanley, Citigroup, BlackRock, Wells Fargo, and Domino's Pizza. So the first one is the JP Morgan, which is scheduled to release their earnings report Friday morning before the stock market opens. The company's earnings release is expecting, earnings has a 34% expecting an earnings beat, which is absolutely terrible. Option traders are pricing in right around 5.5% price movement in either direction, but normally it moves around 3%. Pepsi is scheduled to release their earnings report on Wednesday morning before the stock market opens. The company's earnings release has a 50% expecting an earnings beat. Option traders are pricing in around a 3.5% price movement, which is a lot more than what it usually does, around 1%. Pepsi doesn't move very much, which is probably one of the reasons why it's a very popular one for Warren Buffett. It just doesn't move very much, but usually slowly, gradually goes up. But then we have the Taiwan Semiconductor, which is scheduled to release their earnings report on Thursday morning before the stock market opens. The company's earnings release has a 57% expecting an earnings beat, which is much better than some of these other ones. Option traders are pricing in some pretty nice volatility with this one, around 6.5% price movement, but normally it moves around 3.5%. Delta Airlines is scheduled to release their earnings report on Thursday morning before the stock market opens. Man, we sure have a lot of early ones, don't we? Company's earnings release has a 45% expecting an earnings beat, which is not good either. Option traders are pricing in some volatility with this one, right around 7.5% price movement in either direction, but normally it moves around half of that. Morgan Stanley is also scheduled to release their earnings report Friday morning before the stock market opens. This may be one of the worst ones, where the company's earnings release has a 24% expecting an earnings beat. That is absolutely terrible. But again, even though, like I said, it's good to try to avoid earnings or splits, because these are considered a lottery play, where you could get or experience an IV crush. But a lottery play is definitely something we want to go light. If you want to be risky and you feel, you want to chance it, you go ahead, and you could pick a direction, but go very, very light. A lottery play is just like if you were to buy a lottery ticket. You don't expect to actually win, but if you lose, it's money that you're not going to be worried about. And so this is the same concept. But if we figure out what the opposite of 24%, that means that we have a 76% chance, or expecting an earnings miss, a 76% chance that this could easily go down, and it could move 6% in that direction. So as a lottery play, we maybe want to buy a put on it, maybe right before close on Thursday, because if it does become pretty volatile, we could easily profit from it by knowing what's going to happen before it happens. And so Citibank right here is also expected to release their earnings report on Friday morning. And so the company's earnings release has a 34% expecting an earnings beat. Now, if all these just miss and all at the same time, it's going to create a big snowball effect. And so option traders are pricing in around a 6.5 price movement on this as well, but normally it moves about half of that. United Health Group, which is also expecting to release their earnings Friday morning before the stock market opens. The company's earnings release has a 49% expecting an earnings beat. However, option traders are pricing in around a 4.5% price movement, which is also double compared to what it does in the past. BlackRock, which is a very interesting company, they're more or less like an investment company, but they like investing in interesting areas. But the BlackRock, which is confirmed to release their earnings on Thursday morning before the stock market opens. BlackRock's company earnings has a 21% expecting an earnings beat, which is very interesting, and wondering how that could be, as they're like investing into a lot of weapons and oil and a lot of other things. But again, with oil's been a very interesting topic lately, and maybe they're affected by that and many other things. So investors are expecting a miss, pretty much. This would be a 79% expecting an earnings miss. Option traders are pricing in around a 5.5% price movement, which is more than double compared to what it does in the past. So expect some volatility on that one, as well as Wells Fargo, which is expected to release their earnings on Friday morning as well. The company's earnings release has a 33% expecting an earnings beat, while option traders are pricing in around a 6% price movement in either direction, when normally it moves around 4%. Domino's, last but not least, Domino's Pizza is expected to release their earnings on Thursday morning before the stock market opens. The company's earnings release has a 41% expecting an earnings beat. Option traders are pricing in around 7.5% price movement. As this earnings release comes out, I'm sure they'll start talking about inflation and how probably people are trying to, save money. People, when it comes to food, I mean, food has not either gone up 50%, if not doubled. People are slowly, buying the things that they need, not so much what they want. And so, getting, Domino's delivered is definitely a want and not a need, so we can easily start seeing these numbers begin to drop throughout the next actually they've been dropping throughout previous earnings seasons, and you can always see the previous analysis by just by typing in the this code in our little search bar, and you'll be able to find all kinds of posts and previous analytics within our group. And so, but it's also important, as we do our due diligence of the weekend, is to also refer to investing.com's top 5 very important things to look for in case if there was something that we may have missed. That way we want to make sure that we include it within our due diligence and our research. So the latest U.S. inflation numbers on last Thursday on Thursday, coming up, will be awaited by investors who have repeatedly had their hopes dashed for a pivot away from an aggressive rate hike campaign by the Federal Reserve. Wednesday's minutes of the latest Fed meeting should offer some insights into how officials view the economy and the inflation outlook. Comments during the week by several Fed policymakers will also be closely watched, while big banks' earnings on Friday are expected to show that the impact on raising interest rates and market volatility. Oil prices will remain in the spotlight after the OPEC Plus announced its largest supply since 2020, and the United Kingdom barrage of economic data will test the recovery in sterling. Here are some of the other things that we need to know, and the first one is the U.S. inflation numbers. So we've already talked about that. That's going to be the number one reason for, or one of the number one biggest reasons for our volatility this month. So, and then the next one is the Fed minutes and the federal speakers, and then number 2 is the big bank earnings that we just went over. Number 4 is the oil prices. I mean, geez, look at this. So we go to bar chart. We just go to the front page. Look at the price of oil, $92.64. It was up 4.74% last Friday. My goodness. And so that is going to be huge on the spotlight, especially as the oil productions and things of being manipulated, especially the pipelines and everything. Just what a mess. And then number 5, last but not least, is the United Kingdom data from the Bank of England and their Financial Policy Committee. And so this is going to be a very huge volatile week, but it's also important that you guys also utilize Joe Biden's and the White House schedule. You just Google it. Just Google Joe Biden's schedule, and this schedule updates every midnight in Eastern Time or 9 p.m. Pacific Time. So if you're in the Pacific Time, you may be still awake, where you can view what the government scheduled Joe Biden's and the White House schedule, because these provide almost just as much volatility as the economic report, depending on what's anticipated to be discussed or what the meeting's about. So now there are typically the press conferences, and there are the Joe Biden, delivers a message, type thing. It could be about the economy or creating jobs or whatever. It could be bullish. It could be bearish. A lot of times we can know that just by reading, what the topic is. And so let's see if we can kind of go down and find something here. Tuesday. So there's one right here, like a press conference. So you have press briefing. It tells us we never know exactly what the press conference is going to be, but it's typically the general stuff. And for to answer your question about, I wonder what they're going to talk about. So imagine yourself as a journalist. What if you were a journalist? What would you ask the White House? Especially watching all this news and stuff about North Korea, Russia. These are huge topics, especially topics that would create a lot of volatility with the stock market. These journalists want to know about it because that way they can create news articles and blast it out there, because it just creates attention and stuff. So, but it's the same thing for us. We are like the journalists. We want to know so we can know how the market's going to react to it before it reacts to it. And so that's why we want, and that gives us an advantage because we can see what's being said live before the journalist creates an article, blasts it out, because it could take them minutes, it could take them hours, an hour or longer to create an article, blast it out there. By that time, the market has already reacted to it. And so that way, that's what. Same thing with the economic report. We know what's scheduled. We have an idea if it's going to be bullish or bearish. And now this is the same way. So because if you're not watching this, I assure you Wall Street and all those other professional traders and investors are. So it only makes sense that we do exactly the same thing. And so here's another one. The president receives a briefing. So the president delivers remarks, full text and analysis. But a lot of times we can see that a lot of this stuff may happen right around power hours. So they do this stuff on purpose, you guys. There's a reason why they have these economic reports 1 hour before pre-market, because it just creates more volatility, more opportunity. It's more financial gains in our pocket. They're doing it for their gains. We got to do it for our gains. And so, and they do it because there's no economic reports during after hours. I mean, not after hours, but during power hour. So they schedule this to create more momentum, whether it be bullish momentum or bearish momentum. And so, but it's just, these are great tools, you guys, to really use. If you're not using them, to enable to get different results, you have to try something different. Otherwise, if you keep doing the same thing, you're going to get the same results. And so these are just very, very powerful tools that are all for free that you can take advantage for your benefit. And so, so the next thing that we can talk about is the quantitative tightening, or what we'll call it within our chat rooms is QT. QT is quantitative tightening, or QE is quantitative easing. Right now we're going through quantitative tightening. And what that means is that the government is selling a massive, billions of dollars worth of stocks. Now, I started to learn this back in 2020 when the government was doing the easing part. That means they were buying stocks. Now, the government closed down the economy. They told everybody, go home unless you're essential, working at a grocery store, medical facility, or whatever. Then you have to stay working. But for everyone else, go home and quarantine yourself for a couple months. Let's get this thing cleared out. Blah blah blah. Well, the companies, the stock market just plunged. Because companies they weren't profiting. They were losing revenue, and it was just a big mess. But keep in mind, we went through the swine flu, bird flu, H1N1, and whatnot. We didn't have to close the economy. We stuck through it. All it is our yearly flu that mutates and has different effects and stuff, whether it be minor or severe. But it just mutates. It is what it is. But the world leaders chose to close down the economy, and they know what the cause and the effect is, whether they know it or use artificial intelligence, computer analysis, whatever. They're not dummies, and so they know that they causes the market to plunge and all of a sudden they started buying billions and billions of dollars worth of stocks. Now, we saw oil go under $1 a barrel, and here they are buying billions and billions of dollars worth it. And their excuse was, we're doing this to kind of keep the economy afloat while you guys are at home. Go ahead, take some stimulus money, take a vacation, or do whatever you got to do if you're home or having issues, whatever. Here's $4,000. Here's another $4,000. It was just very, very interesting how everything happened. But again, we weren't sure if we were going to have an L-shaped recovery or a V-shaped recovery. Obviously, we had a V-shaped recovery, and it easily bounced back. And the government has made a substantial amount of trillions of dollars in gains, and now they're selling the stuff that they bought, but they're being very, very sneaky about it. Now, when they were buying, I had called it pump days. These are our dump days. Now, they had a schedule. One of you guys, one of our members who's in this financial system. That's what's nice about our group. We can learn from each other, because out of our amount of members that we have a 250,000 members in our group. Everyone is somehow tied into every single industry and company on the planet, and so if we want to know something, we say it, and one of those guys will come out and they'll provide us some feedback, and that's what happened, and that's why I was able to learn that there is always going to be a schedule. It might not always be in the same place, so it becomes harder and trickier to find and to understand, but we, as long as we know that there's a schedule, we can plan ahead. That way we can react to it. Now, when we did the financial easing, Donald Trump was president, so it was a lot more easier because he was kind of in our favor. He would always help us out, give us subliminal messages and things like that. And it was pretty consistent. So, but now things are a little different. Things are trickier. The thing with the quantitative easing is that it only lasted for like a couple months, and they only did it like once every couple weeks or so. Where with the quantitative tightening, is happening pretty aggressively and twice a week, and it's going to be that way for a couple months. We've already been through it for about a month. We got 2 more months, and then it's going to start slowing down. Then it's going to be about 1 week or one time every week, and then it'll be once every 2 weeks, and then once every month, all the way up until about September, and then boom, that's done. But that's also a sign that most likely the investors are going to see the light at the end of the tunnel, and the stock market is going to surge like crazy, because investors are going to start. They're going to know that the government's going to start doing interest rate easing. There's no longer quantitative tightening, and so the whole market is going to take a big shift. But it's going to take a long time until we get there. Next summer, and so I would say probably June. June is probably when we'll probably start seeing the market doing a lot better, and that's when I think investors are really going to start seeing the light at the end of the tunnel, because we're only going to have a few more quantitative tightenings. But this is a great opportunity, guys. Bad news is great and phenomenal news. We can utilize this information for our advantage, but the important part is knowing the dates of when it's going to take place and then how much. Now, this is in the billions. $19 billion was just sold last Thursday. Now, when the government was starting to execute these orders, the first few weeks, they were kind of doing it like during pre-market and then during the middle of the day. We're trying to analyze this to figure out when are they executing it, because sometimes they'll even be trickier by, like, for example, last Thursday versus Friday, they executed a majority of this during the after hours, and they could have executed it like the last second during the after hours. And what that it doesn't show a big impact on the Thursday market, because now people are like, oh, this is scheduled to be Thursday. They're thinking Thursday morning, pre-market, midday, and maybe the day's green or whatever. It's like, oh, how come this isn't working, whatever, because the government's being tricky. They know that we know now. And so, but these dates, it has to be executed on these dates, because that's the plan. But they're being tricky. If they execute it on the last second of that day, that means it'll have an effect on the market the next day, just like it did Friday. So we had a massive amount, billions and billions of dollars worth of stocks that were just sold that kind of pushed itself into Friday. And that's one of the reasons why we saw a massive plunge in the entire stock market system, as well as some of the other bearish news that just made a bearish day more bearish. And so, but this kind of gives us a level of that volatility, knowing how bearish that day is going to be. So like Friday, for example, we have another one here, November 3rd, which is they're going to sell $21 billion worth of stocks. That is a lot. Just trimming the fat right off the stock market. That is absolutely crazy amount of money there. But the total amount so far that they're going to secure is $308 trillion. Hey, all that money that went to Ukraine, they got to make it up somehow. Just like how Elon Musk selling some of his Tesla stocks, that way he can get ready to buy Twitter. And so this is but this is a substantial amount. The government made so much money. With the quantitative easing and now the quantitative tightening. This is all probably pure profit, and so that is just so substantial. But like I said, it's just great to know these characteristics and what's going on, so that way we can always plan ahead for our advantage. And so hopefully everything makes sense. Anybody have any questions? Anybody want to bring anything to the table?
Hey Carlos, if you don't mind. Yeah, if you don't mind, I have a quick question related to your last slide here. So the bond market is going to be closed on Monday. Do you think that's going to be bullish for the market?
So the bond market will be closed, you're saying, on Monday, but the rest of the stock market will be open. Are you? So that could. Sometimes when something like that happens, it creates more volume activity with the things that are open, and so this could be. But a lot of times people like looking at bonds activity to measure what the market may be doing. So I would say that kind of to be determined, but I would say that most of Monday's early activity is going to be based off of the bearish weekend news and coming back from a very extremely bearish Friday. But I think a majority of investors and traders are thinking kind of the same thing, and that there's a good chance that after opening things start to kind of calm down, that we could potentially open in the green, especially with Tuesday, not much scheduled to happen on Tuesday. Not much really happening there either, but Wednesday, with the PPI report being a little higher, we could also carry from a green Tuesday into a green Wednesday. So, but it kind of.
I have an observation.
Sure.
Yes, on Friday, oil prices were very high. I think they had reached the highest for many months. About 5% up in one day. But the share prices for oil companies, they were down. So I don't know that kind of phenomenon. I really don't know what it went down. And also the question is, will the share prices like Song, Oxy, will they catch up? Catch up with the current prices?
That's a very, very interesting question, and so shortly after Putin had announced that he's going to recruit and send 300,000 more Russian soldiers into Ukraine, usually when that happens, we know that oil is going to go up, but it didn't at first. The market didn't really react to his words or decision yet, because usually when that happens, the market or the world is calling his bluff, like, yeah, right, you're lying. But as soon as the Russian that gas pipeline was sabotaged in the ocean, and it created a shortage. I mean, a lot of the news is saying, oh, the Russians sabotaged their own pipeline. But when you start talking to other, enthusiasts or veterans, most of them are saying most likely, we probably sabotaged it, creating a shorter supply. And the evidence is showing that it was detonated with explosives, most likely in a very low depth. It was probably used using submarines. And so, but a lot of veterans would say they believe that the United States could easily have been involved in that. Creating a short supply and a high demand creates a much more valuable commodity. And so, but with the way gas prices, or not gas prices, but oil gone up, it is very interesting to see that oil companies have actually gone down. And I put a massive amount of money towards a money market account towards oil, and watch, even though oil value has gone up, but the oil companies have gone down. And so I think that the way that the market has been bearish, it's just pulling down everything with it, because oil companies should be doing better. But most of our oil that we get is from Canada, and our government is trying to make sure that our oil American companies aren't really producing as much. But I know that recently our government wants to tap into some oil or fuel reserves and stuff to try to make up for the high oil gas, or the high oil prices. But to be determined. We'll see if they actually do that or not. And that's where the crude oil inventory levels are going to kind of help provide us this information. So if it's a pretty high level, then that means they are putting more reserves in there, as well as maybe less people are driving. So oil is kind of really weird. Oil seems to be very, very manipulated right now.
I want.
Go ahead.
Carlos, I wanted to congratulate you on a great presentation and thank you for the information. I wanted to ask you on an AMD, you made a comment at the beginning that the volume versus the open interest was quite high, and you think that AMD is gonna be quite positive on Monday. Can you give me your technical analysis on AMD? I'm just curious as I'm not trading options, but how are you using options to look at the, let's say a next day for a stock? Because it was really beaten down 14% on Friday.
That is correct.
Thank you.
And utilizing the options activity and the analysis is a great way to figure out where people are putting their money, even if you're not into stock options. But it's just still good to kind of know a few key points. That way, for your your intelligent buying and selling decisions. And so, but by looking at the most active stock options, we can see that AMD is in third place. It was down substantially, but we can see that out of this amount of volume, is not only are they day trading, but a lot of them are also going to be swing trading throughout the weekend. But out of that, we have about 57% are calls, where about 43% are puts. So that's one way we can kind of observe that, as well as maybe going to the option volume leaders by looking at other most active things. But we have to make sure that it's still active and no longer expired. But we have this AMD call strike price at $63 that's still active. We have a tremendous amount of volume activity, a lot of volume activity with very little open interest, and now it has a lot of interest. This is pure buying activity. When you see something like this, this is a very, very good chance that it could easily bounce back, and it could potentially bounce, whether it be halfway or all the way, within a short period of time, because that's pretty low for AMD. That's too low. Even though when I used to trade AMD when it was around $20 a share, but if we want to go more into depth, we can utilize the NASDAQ options to kind of zero in. But when we're looking at the AMD's most active calls and puts, during the weekend. Some of these are going to be expired, so we'd have to click on some of them. They used to be, before NASDAQ redesigned their website, there used to be the expiration date on here on each row. Now you have to click on it to actually go to the next page to see the expiration date. That way you can determine if is it still active or if it's expired. Still loading there. There we go. So we got October 14th. So this one is still active, and again, it is the most active one out of all of them. So let's go back here. So we have this 63, and you can see all the volumes, from the very top. The second most highest volume out of all these is the $60 put, and it has 48,000. Let's see if this one's still active. We'll just click on it. October 7th, so this is no longer valid. It is expired, so it'll disappear once we get into Monday. But look at that gain, almost 8,000% gain. Man, that's a lot. But a lot of people are betting that AMD is going to bounce back up going into Monday by, again, 57% or so, which is almost 60%. And that's why we can always straddle too. That way, if you're not sure, especially going into the weekend, with some of the bearish news that can be implemented, we can go 60% calls and 40% puts. Or again, if you're just buying shares, it'd be a good one to get, because if you're buying it at $58 and it bounces back up to $65, that could be a nice little 5% gain in a very short period of time. So hopefully that makes sense. Another area for those that like to hold longer, a lot of us will go to we'll go to like AMD. We'll go to Google, we'll type in AMD, go CNN forecast. And then that way we can kind of see what CNN's analysts say about AMD, especially with right now. Now, even though AMD is down at $58.40, out of 36 analysis are saying that the low side is about $60 and the high side is about $200 in 12 months. Combined, out of the 36, a lot of them are saying that this should be a $100 stock all day long. And so, but when we're looking at these types of forecasts, very rare do we ever see that the worst case scenario is higher. I mean, this is a no-brainer, for those that are buying short-term and long-term. It's the other ones that are, let's say, what's another one? Let's look at Apple. Apple could be lower, worst case scenario, and it is. So there's 37 analysts that are evaluating Apple's stock, and out of the 37, the worst case scenario is $95 for Apple. Best case scenario is $220, and but most of them are average is about $185, which Apple was not that long ago, $175. So we can easily get back to there, especially if they provide any clues or any progress on their electric vehicle progress. That could easily create a big surge. But overall, most forecasts we usually see something like this. Never do we ever see anything like this, where the low is still higher than what it currently is. So hopefully that makes sense. Hopefully that helps. Anybody else have any questions? Anything you want to bring to the table, or anything before this is over?
Me, please tell us history. The question was more about the math of the strategy, because I would like just to know, like, if you straddle a stock and you go just $2 up or $2 down, I see that the amount of loss on the put will be the equivalent of the call on the upside. I would like also to know about what is the percentage amount of an account for a straddle, And also, how about the stop loss and the profit target for your strategy? Thank you.
You know, those are all very great questions, and most of us will rely on the moving averages. Moving averages help provide us our buying and selling signals. I'm going to upload a couple images. We can kind of go over those really quick just to kind of show, because some people like to try to get, you know, maybe a certain percentage out of something, but ultimately we need to focus on our buying and selling signals ultimately, because if we're trying to provide goals or I'll sell once to get to this point or whatever, you know, if it doesn't, and if it goes the other way, then you know, that could be catastrophic. And so that's why it's extremely important that we utilize the moving averages. And I've provided just kind of like these little quick little simple images that kind of lets us know as a reminder what a buying and a selling signal is. So if you have a call or a put, you know, if in these candles, this is just kind of our price line, then the moving average line is the white line. Well, the crossovers are the signals letting us know that the trending direction is changing. So if we have calls and it goes down, then that's the time to sell. Or if it cuts through the moving average line, that's the time to buy. Or vice versa, if you're holding puts, if it starts to go down, that's time to buy puts. Or maybe you're straddling and you're holding both. Again, we usually want to wait like within the first hour, waiting for the signals to sell. You know, we can either sell at the same time, or we can sell at different times, maximizing our gains and minimizing our losses. So if the opening, let's say the stock market opens up, and we're holding throughout that hour, and then the stock market, whether stocks are up or down, the price falls, and then it begins to come up. This is when we want to sell our puts but hold our calls. Hold our calls until, because it's going to keep going up. We just secured gains on our puts and we have losses on our calls, but maybe now it's going to go in the green, and now we may be able to secure gains in the calls. And then it says buy puts there, which we can maybe if you're going to day trade. But it says here to sell the calls. So we sold the puts when it was down here. We sold our calls. We're in and out. We can avoid the rest of the day. Avoid the day, because it can mess with your emotions. It can mess with your mind if you want. Or day trade if you're very fluent with the moving averages and the buying signals, because there's a lot of great opportunities when it comes to day trading. But when it comes to swing trading, that's what's nice about this swing straddling strategy, is because we buy 5 to 10 minutes before and then we sell them the next morning. It kind of feels like day trading, but we have unlimited swing trading. But with what day trading passes you do have, now we can trade, you know, those, you know, throughout the day, and until you reach $25,000, and then you have unlimited day trades, and you can, you know, day trade all you want. But it's important to really utilize this more than, you know, and especially with break-even price. Avoid the whole break-even price, because that's just going to mess with you even more. A lot of people think, oh, I have to hold until it breaks even, right? No. Break-even is if you holding until it expires, and you don't want to hold on to it throughout its expiration, because that's when the time decay is really going to kick in. We got to kind of think of it like at the grocery store. You know, we have a gallon of milk or a loaf of bread there. There's an expiration date on that. The closer it gets to its expiration date, the more it's going to devalue, and to the point where they're going to have to put it on clearance and reduce the price. Because once it does expire, now they have to throw it away because it's worthless. And then expiration is with an option is the same way, and we want to get in and out and be actively trading, not actively holding. So hopefully that makes sense. Anybody else have any other questions or want to bring anything to the table, or are you guys good, ready to rock and roll?
How about the position size?
So the positions
Like on
side,
three.
usually we want to do about 50-50. I mean, at most maybe 60-40. You know, if you're more certain, it's going to be more on one side over the other. If you're really, really certain, maybe 70%, 30%. But that may be too risky. In case if you're completely wrong, it goes the other direction. That 30% might not be enough to make up the difference on the 70%. So usually it's best to stick with that, either 50-50 call put ratio or 60-40 call put ratio, just like we see everyone else doing here under the most active options.
I mean the percentage of account size.
Say that again.
I mean the percentage out of the account.
Oh, okay. Yeah. So again, with the top 5, those are the ones we usually want to do. We want to go heavy. So usually, like for example, what I'll do is, I'll go pretty heavy. I mean, everyone's a little different, and but usually the heavy ones are going to be like Amazon, Apple, and Tesla. Amazon though seems to have the least amount of time decay out of all of them. Apple, I would say, has the second least time decay. And AMD and Tesla probably have about a fair amount of time decay, but like I said, if you're looking for the least amount of time decay, start straddling Amazon, if not Apple. These two are great, and then the next best ones are Tesla and AMD. But every once in a while we'll see some ones that are up here that are not normally on here. They're just trying to butt in a little bit, but focus on the primary ones, the top 3 ones for the most part, which are pretty much these guys. But like I say, go heavy on them. Meaning it could be maybe 20% of your account on Apple, 20% of your account on Tesla, 20% of your account on AMD. These ones are they're our prime, they're our bread and butter. These are our primaries versus anything that's like a lottery play. That could be 5% of your account or maybe 10% of your account. Not a whole lot, because that could be unfamiliar territory. It could be catastrophic. Maybe there's some kind of manipulation. The earnings maybe coming up. Maybe you're missing something, whatever. Focus on the majority and stay heavy on these guys. And the volume shows it. You can see that Tesla has 3 million in options volume. Apple, AMD has 1.5 million. Then Amazon is about 0.8 million. Then they all start to kind of fall drastically below that. So as long as follow the money, follow the where things are going, and you just repeat the process every day, and you'll consistently gain every week. And whether you're gaining 20% a day, that's 100% a week. You're doubling your account every single week. And eventually you'll get to $25,000. Now, if you're not at $25,000 now, once you do, you're like, holy shit, what do I do now? Because when I first got to $25,000 years ago, I did not want to jeopardize that. I felt like I was starting over. So I had to put another $500 in there and just play. But I felt like if I can turn $500 into $25,000, I can. If I did it once, I can do it again. So I decided to just start trading with the $500, but leaving the $25,000 in there, but just imagining it wasn't there anymore. Focusing on the $500. Now I can do the continuing my straddling. Now I have unlimited day trades, so I can do that and then continue to turn that $500 into another $25,000. And then just kind of keep going from there. So that's what my mentality was when I reached that. But it was weird because I wasn't expecting that feeling until I got there. And so I'm just letting you know, you're probably going to get the same feeling once you get there yourself. But just don't stress out. Just stick with because the percentages kind of stay the same, but the dollar amount gets huge. Where you may be getting used to trading $100 here or there, but it's going to turn into thousands to 10. You're going to start trading $10, $20, $30, $50,000 days. I mean, that's going to be huge. That may mess with your melon, your mind a little bit, but you got to stay focused. Stick with the basics. Stick with the process. Stick with what we know and with what works. Don't change anything. Any other questions?
Yes. Hi, Alice.
Hello.
Thank you for your time and effort. I have a question about flat days.
Yes.
Just to make sure, you say that if we have puts and calls and the day is kind of flat, it's better to just sell both position. I mean, puts and calls within the first hours rather than waiting and hoping that it takes a direction.
That is absolutely correct, and it's just like I said, trying to avoid a fight so you can live to fight another day. And so that way we're not holding throughout the day, because you could lose 5, 10, 20% just from time depreciation. And it'd be better just to bail out being at a wash or being even, or even a little bit of a loss or slightly of a gain, rather than risking and hoping that things may work out throughout the middle of the day, even though nothing is scheduled to happen. It's all just kind of an autopilot, whatever. We want to avoid that. We need volatility. And so one of the other things I just uploaded here regarding that is kind of the differences between an amateur trader and a professional trader. And it's important to know the differences between these two, because that way we know the difference between right and wrong. Because we don't always know the difference between right and wrong unless we're taught it. Just like if we were kids and our parents taught us, the right and wrong. But with the stock market, we don't really have that kind of coach or mentor, up until now. So amateur traders will typically let losers run and hope they turn around. And there's that word, hope. I call it the hope system, and that's something we have to avoid, because we have to think analytically, strategically, and statistically. And so where professional traders will cut losers when a stop is reached and a trade idea becomes invalid. So if the day is flat, then that means, okay, it's invalid, and this is our stop. Our stopping point is that 1 hour. So we bail out. I mean, unless we know something is going to happen, we can always get back into it later on, avoiding that time depreciation. Amateur traders will often close winners too early. We see it all the time in our chat room. Oh, the market's still going down. I should have held my put. We got to utilize our moving averages, both the 1 minute chart and the 5 minute chart together. Because a lot of times, a lot of people that are trying to figure this out, they may be leaning more on the 1 minute chart, and it may be more devastating because it's more volatile, it's moving quicker. But the 5 minute chart is our primary guide, and we want to really focus on that one, the majority. So but sometimes the fear is the emotion that affects our buying and selling decisions. So that's another thing we got to try to practice in controlling. That way it doesn't control us. So professional traders will let winners run until profit order or when a clear signs are given to exit. Trust their system, and that's the moving averages is our system. As long as you have it configured perfectly and understand the crossovers are buying and selling signals, trust the system, and it'll work for you. Amateur traders change their trading systems after a few losing trades because they think, and a lot of times the market's changing, and we went from a bull market to a bear market, or this and that and whatever, and they may think they're trying something different and it works, but then all of a sudden the market changes and no longer works, and then they have to start over. We don't have to do that through straddling. We can straddle year after year, no matter if it's a bear market, bull market, or whatever. That's the beauty. We never have to change that. Why? We don't have to fix something that's not broken, and straddling is not broken. It is, and so professional traders will stick to their rules religiously and think process oriented. And that is huge. These rules, these things that we go over, we have to do these religiously, and again, think process and oriented and analytically. So amateur traders close their trades, never look at them, and avoid a learning effect. And so sometimes you get a lot of people in the groups and stuff that ask, I have $1,000, what should I invest in? Because they're just not learning. And so where professional traders will analyze their past performance, but also keep a trading journal, or even learn from their past behaviors, or learn from other people's mistakes. That way they don't make the same mistakes. And that's one of the reasons why we like to analyze a lot of things. Amateur traders tend to sometimes overtrade or revenge trade, which can lead to their emotions controlling them, because maybe something isn't going their way, and all of a sudden they're doing something that are now violating these rules. And sometimes they hope to make a lot of money fast, and there's that hope word again. There's nothing wrong with making a lot of money fast as long as it's made doing it the right way. Professional traders are aware of their emotional impacts and know how to identify and manage their impulsive buying and selling decisions. Amateur traders open their trading platform and then desperately try to find random trade entries. They'll just throw money at something here and there, and sometimes they're buying too many options or too many shares. Like I'm saying, like 10 or 15 or 20. That's too many to manage. A good manageable range is probably like less than 5. Especially 3. 3 is manageable. 5, it's too many. But a lot of professional traders may just trade one stock. That's it. That could be SPY, Apple, Tesla, AMD, or Amazon. Just one. And a lot of times they may use 50% of their account, or 70 or 80% of their account, on these guys. And so professional traders will keep a trading plan and planning their trade day or trading their day ahead. Follow a structured approach, and that's one of the reasons why we have our meetings, so that way we can plan our trades, we can trade our plan. And this is our structured approach that I've been able to just kind of fall into it, and I share it with you guys. That way you guys see how I kind of do my due diligence, and that way you can implement that with your due diligence. Because every trader and investor specializes in something different, and so it's nice that you can take that and bits and pieces from different specialists and to create it with your own strategy. But again, this is the majority of it, and the main stuff that the most of the professional traders and investors stick to their rules religiously. And so hopefully that helps. Any other questions anybody has?
Hey Carlos.
Hello.
Thank you so much for the presentation. It was really amazing. I just have one question. So let's say when you're straddling a stock, you did tell us that it is better to not go too long with the expiry because it messes up with the volatility. So what would you suggest is an ideal way to straddle? Like what is the expiry that you would suggest that we use when you're straddling a stock?
Always the soonest expiration date, because it'll give you the most volatility. Usually you'll see those that are maybe experimenting or they have weeks out or even months out with their expiration. That would be more of a short-term, longer-term type of strategy, where you're picking both directions and you hold for months. And your strike price is maybe a year away. That would be a slow straddle strategy, but our primary straddling strategies are very, very volatile and very, very active, and we want to be actively trading them, not actively holding. And so by selecting a sooner expiration date, whether it be 1 week or the 1 week or 2 weeks, the small amount of share movement, the price movement with the share, will have massive price movement in the options world. But the further away you go from the expiration, not only more expensive that it's going to be for that option, but the less volatile that it'll be. So you may gain a little bit on one end, but you're going to lose the same amount on the other. So it's going to be more of a wash overall. So that's why we want to have more of a sooner expiration date. That way we can have more volatility. The more volatility, the better, and the AMD just proves it, where we can potentially lose everything on one hand, 99%, or 100%, but then our gains, like I said, are unlimited. Even if it's a couple 100%, 700%, 7,000%, that will always wash out our loss and puts us ahead every time. And that's what we want. We want the soonest expiration date. Now the ETFs, they have like 3 expiration dates per week. They have a Monday and a Wednesday and a Friday. ETFs it would still be recommended to utilize the Friday expiration, because the Friday's expiration will always have the majority of the volume activity and the puts activity. And it seems to be more valuable. It seems to have less time decay versus getting a Monday or a Wednesday expiration. There just seems to be more time depreciation in those. So it's just better to stick with the Friday one.
Just to follow through on that. So let's say since tomorrow is Monday and I want to straddle spike. So ideally it should be best to put the expiry date for Friday. Am I correct?
Yes, yeah, definitely. And sometimes you can get, if you're too distracted, sometimes looking at those expiration dates may distract you. So it's very, very important that you do select a Friday when you're doing an ETF. Any other questions?
Hey, Carlos, so yes, I have a question.
Sure.
So to follow up on what Sid said, so you wouldn't recommend 1 day expiration, right, on the straddle?
The next day, so like if it was a Thursday going into Friday, that would be fine. But again, we want to sell within that first hour, because after that hour, that's when the time depreciation will really kick in. And a lot of the AMD puts here are a Friday's expiration. So but that's why it's important to implement that 1 hour rule, because the first hour and the last hour of the days are always the most volatile time of the day. And so, but yeah, going in the next day is fine, but just do not be hopeful thinking, oh, there could be more or whatever, because yeah, if you're, once we start actively trading on Friday, we want to get out of that expiration and then start buying the next week's Friday's expiration.
Gotcha.
Hopefully that makes sense. Yeah, if you don't make dollars, it don't make sense. That's what DJ Quick always says.
So I actually tried straddling on. I bought it on Thursday and sold it in the morning. Time decay ate up most of everything on the call, but I sold the put on a profit.
So you bought Thursday morning, held throughout the day, and sold Friday morning?
No. I bought it at the end of the day on Thursday, like 5 minutes before the market closes. Yeah. And then I sold it the next morning. I tried to sell my call as early as possible, but for some reason it didn't go through.
Yeah. So that's another tricky part. So because when we're going into the selling or buying or whatever, it takes some time to put our settings in and everything, and then to send the order out. It could have taken us 5 seconds, it could have taken us 2 seconds, it could have taken us 10 seconds. Maybe we got more distracted, it took you 20 seconds. While we're doing that, the prices are still changing. They're not waiting for nobody. And so it's important that we try to execute this right away. But one way to try to get it the first time is if we're buying something, we can maybe increase the price 1 or 2 pennies, or if we're selling it, we can decrease the price 1 or 2 pennies, because when we send the order out, we're kind of adjusting for that, that possible price change between the time it took you to get it out and to send it out. And so that way, that will greatly increase the odds that the order will get executed the first time. Because if it doesn't execute, then we have to go back into it to modify, replace the order, or just to start it over. Because we want to get rid of that. As soon as it tells us when to buy and when to sell, we need to react to it as quickly as possible. But if it doesn't execute, we need to quickly go in there and modify it until it does execute, But again, to try to prevent that from happening, we just have to change the price a little bit. Now, if we change the selling price just a couple pennies lower, and the price actually goes up, it'll still sell it at that higher price. It'll be in your favor. But it's just in case if it doesn't, we can sell it for a couple pennies lower. Yeah, it'll be a couple dollars lower, per contract. But at least it'll sell it immediately. So that way, if it doesn't work out, we'd have to go back in there and modify it, and the price could have changed by $10 or $20 or something significant, And so that's why it's really important that when we try to send our orders out, that we try to manipulate the numbers a little bit.
Oh, got it. Thank you.
Oh, good. I'm glad that makes sense. Anything else? Everything else ready? Ready to rock and roll for the week? Or anybody else want to have anything? Or?
Carlos,
Yeah.
I'm sorry. I had a quick question. So, again, going back to the post that you made generally about earnings and then what happens when the earnings beat. So, when they say that it beats by a certain percentage, the higher percentage indicates to let the stock go up or the stock go down when the earnings are beat.
So let's go over back to the earnings area. So the earnings. So and this is very, very well analyzed and by many analysts over with the earnings whisper, and but these are a pretty good numbers, very, very anticipated. A lot of them are either 50-50 or a lot of them are going to be more on one side over the other, especially with the financials, the banks and stuff. A lot of them are very, very low. So, but when it comes to options though, they can still be what's called implied volatility crush. So it can affect both the values on both, but we can try to use this as a lottery play where we can maybe bet against it, because 24% expecting an earnings beat, which means there's a 76% expecting an earnings miss. So put is more likely in our favor. So, and if it is, even with a little bit of implied volatility crush with a 6% movement, we still may be able to double our or at least maybe get a 20-50% gain out of it, from puts. But it's good information, and I kind of highlight some of these with these little emojis, kind of pointing out more or less the important areas of the analysis. But if you have shares, maybe you're holding, this can give you an idea. Okay, maybe I should sell before that happens. You can always buy back into it at a lower cost, or if you're looking to buy a share, then you know which ones to avoid. And right now, this is not a good earnings season to really be buying anything.
So unless when you say that the earnings are beat by more than 50%, when we expect the stock to go up. Like last week, TLRY went up quite a bit.
Which one?
The ticker name was TLRY.
Yeah, I don't think that was on our top.
Tilray.
Oh, Tilray. Yeah.
He's talking about.
Yeah, so that was. I don't think that one moved a whole lot. Unfortunately, it was intended to become very volatile, but then we had cannabis news. I don't know if you guys heard the cannabis news, but Biden mentioned about doing the whole, forgiveness. Any kind of cannabis crimes that would have been committed in the past, our government wants to forgive that. And so, but it could be potentially the next step to just legalizing recreational cannabis in the United States. But we had Tilray that was expected to release their earnings Friday morning, but they had a 54% expecting an earnings beat. But we had it says consensus estimate year over year. Right here. Option traders are pricing in around a 16% price movement, which it actually, it was like what, $3 went to $4 with that new. It was up like 30%. So this was already it was already kind of priced in. with whatever news that had came out. And so the cannabis industry is going to be very, very interesting. I don't know how long you guys been trading, but in several years ago, Canada decided to do a vote. Let's vote to see if we can legalize recreational cannabis. And they voted sometime in the middle of the year, and it passed. But anytime when something votes, it doesn't actually get legalized. It doesn't go into effect until the next calendar year. And so when they voted, it passed. Cannabis stocks used to be penny stocks. They were $5, a stock, and all of a sudden they surged to $20, $50, $100, $150. And then when Canada actually legalized the cannabis the next calendar year, there was too many farmers, there were too many growers, there were too many producers and stores and stuff. It was an industry that was once profitable, but now the market has flooded itself. It is no longer profitable. So what companies that had some substantial growth now had a substantial decline and fell right back down to penny stocks. So this is going to happen again. It's a kind of a once in a lifetime opportunity, but this is a second time it's going to happen, and that's it. So recreational cannabis is going to get legalized in the United States in two ways. It's either going to happen automatically due to the fact that a certain amount of states will have legal recreational cannabis. The number is like 20 or something like that. So once there's 20 states that have legalized recreational cannabis, it'll just become automatic that all 50 states will then have it the next calendar year. And that will cause a massive surge in between the time they mention that it's going to happen to the point where it will actually happen. This is an opportunity that we ride the wave up and then quickly get off, secure our gains, and to get out. This is not a long-term industry, long-term type stocks. But the second way that it'll get legalized in the United States is that they're going to vote on it. And this has happened a couple times already, but it has to go through these voting channels. And the first channel always seems to vote yes, but then it goes to the second channel and they vote no. Well, then they have to start over the next calendar year and hope that it'll pass. So, but either way, it's going to happen. It's inevitable that it's going to happen. It's just a matter of when it's going to happen. And so, but once it does, these cannabis stocks are going to skyrocket. You're going to get like 1,000% gain just from even holding it as a share. If Tilray is $3 a share, and it gets to $30, there's 1,000%. It gets to $60, there's 2,000%. It gets to $90, there's a 3,000% gain. Just from holding on to that. But like I said, once they legalize it, the whole cannabis industry in the United States is going to flood itself, but we're also going to see some weird stuff happen, like corporations may start getting more into it, or like Walmart or whatever may start selling CBD products or something, or maybe Coca-Cola or Pepsi may offer a CBD drink, or maybe Budweiser or somebody, or Corona may offer some kind of cannabis THC in their drinks. We're just going to see some very interesting stuff, but also a lot of our your favorite cannabis family-owned stores may struggle because we have corporations that are now in on it now, and they're going to dominate things. And so it's going to be very, very interesting transition. But just know that this is going to happen. It's just a matter of when it's going to happen. But yeah, Tilray was very interesting activity over the last week, and we could see more cannabis activity here this week if they talk more about this whole cannabis crime forgiveness thing. Any other questions? Anything else anybody wants to talk or go over? All right, looks good.
Actually,
Sure.
we had a question regarding that.
What's your question?
Regarding the FOMC.
Oh,
regarding
yeah.
the FOMC.
Yeah, what's your question?
So I think the FOMC speaks around 2 or is it 3 p.m. Thursday?
So that is what?
Any?
I know I'm in the Pacific time, so I'm always off on that. So that's the 2 o'clock Eastern time. So that would be 2, 1, 12, 11 o'clock Pacific time. So sometime midday. So 2 hours before the stock market closes. Is that right, or is it 1 hour before?
Gotcha.
But
Gotcha.
it's definitely going to create some
Yeah.
volatility during a power hour. And it does provide a little description here on. Go ahead.
So a straddle wouldn't be ideal for that day, right? We might see, the market going side to side early in the morning and then in the mid-afternoon, right?
The straddle would be good with this kind of activity, especially if we have morning activity. So, Tuesday could potentially be flat, and so that could be a way we could maybe avoid straddling, or maybe avoid doing anything Tuesday. But Wednesday we have an economic report that's scheduled to be released 1 hour before the stock market opens, so that could create some massive volatility early in the morning before the stock market opens, and that's definitely going to be in our favor when it comes to straddling. So Wednesday morning looks good, and then during even maybe maybe before this event happens, maybe we can start buying our straddles, and maybe you could pick one direction and go that way, hopefully into the next day. Otherwise, just wait until the last 5 minutes before close, and then whatever it does. And it could be pretty massive. If there was a big massive drop, maybe it could surge up Thursday morning with some of these reports, these are usually very desirable when it comes to looking into straddling, because this is what we want.
Thank you.
Yeah, usually there's Tuesday, Wednesdays, and Thursdays. Usually we don't see a whole lot of economic reports scheduled on a Monday or a Friday, but in this case it looks like maybe because of the holiday, Monday being, it's kind of a holiday, Columbus Day, but it's not really enough. I think it's going to affect things, but it's just very interesting how they have Friday as the but again, a lot of times they do this on purpose to strategically create volatility on certain days. So Friday they may have something like a certain maybe Biden has some kind of something scheduled to happen on that. I wish we had a schedule for the White House and Biden that was a week in advance, but because things are always changing for them, to the point where I think their schedules is scheduled on a daily basis. And that's why it's important that we always Google Joe Biden's schedule, bookmark this page. That way you can look at it regularly to determine if there's going to be a press conference. If there's no press conference, there's no volatility, whether it be up or down. So the day will most likely continue to be flat. If Biden doesn't speak, then same thing. There's no volatility. So we have Friday right here. The president delivers remarks on building the economy from the bottom up and middle out. That's kind of weird. Bottom up, middle out. It's like, what in the world? So, but this is a time frame that lets us know, prepare for volatility at this time or around that time. Sometimes it could be a little early. Sometimes it could be late. But it's very important to, and a lot of these are always going to be live on YouTube. Just go to youtube.com, type in Joe Biden live or White House live for the press conference. And then that way you'll be able to pull up the live video every time. So you don't have to search for some news application or anything like that. Any other questions? Are you guys all good? All right, guys. Let's. We'll call this. You have a question? Anybody?
Yes, sir. So sorry. I do have one question. I would like to ask for advice.
Sure.
So I am 19 years old, and I love to learn in China. This is my first time ever joining your call.
Nice.
Joining this group, and I was wondering, for advice anyway. If you were to start from the beginning, start fresh, brand new, you were starting out learning, trying to get a better understanding. what do you do now to better prepare yourself for the future?
And it's one of the things that we do to prepare ourselves for the future is to always know what the future is going to do before it happens. A lot of people don't know this. They think that things are just whatever happens when it doesn't. There is a cycle. I'll show you here. I gotta upload it here really quick. I gotta find it. But so the stock market has an economic cycle. Not only does it have a yearly cycle where typically 6 months things go down, then the next 6 months things go up, but the economic cycle is usually like a 10-year cycle, where and you've kind of maybe noticed, like for example, the housing crash in 2008 and the financial collapse, or the automotive bailout. That was a little over 10 years ago, and so every 10 years we have to go through like this recession or whatever, where price, inflation, things are really high and then really low and everything. So and it really depends on your style in trading and investing. Whether you're more into a long term or short term. It just really depends on you. I was more into, I've always been, an entrepreneur. I was always self-employed, growing up. In high school, I fell into becoming a graphic designer. I became a graphic designer, website developer, and a digital marketing specialist. I did it as a hobby, but then all of a sudden I had neighbors and friends, families, and stuff that were like, hey, you can design, we'll pay you if you can design us a website or a business card, menu, flyer, or something. And so I fell into that, and then I started learning more about stocks, because stocks, you don't have to rely on customers and shipping things or merchandise or whatever, or sales. This is just you and your software, or us as a team, and so that way we can stick together and provide valuable information. But it's also important to know these cycles in certain things. So the GPD growth, which is the economic growth, but you also see as we go through these cycles that I'm displaying here for you on my screen, is that we can see like the Fed easing the interest rates, but then we can see that the Feds are neutral on interest rates, or Fed begins to tighten the interest rates, which is kind of where we're at. It says sell financial and housing retail stocks. I mean, doesn't that make sense that that's where we're at right now? I mean, we just talked about the financial earnings, about how like Morgan Stanley and Chase, Wells Fargo, they all have like a 25% chance expecting an earnings beat, or a 75% chance earnings miss, because we're in this phase right now where the interest rates are very, very high. People aren't getting as many loans anymore. And so as the bank stocks are beginning to plunge, we're in this phase where it's time to sell the financial stocks, the mortgage companies, housing stocks, retail stocks, auto stocks, because we've noticed that they're all coming down. Now it says to buy metals, materials, stocks, because precious metals, because the value, the inflation is gone up. They're more, because high demand, low supply. And then as we get down through the economic, then it says sell paper and chemicals. We have the third federal interest rate tightening, and then so on and so on. And so, and then it just repeats itself over and over and over every 10 years. So this is very, very great to know. That way you can always plan ahead with your investment strategies and everything, rather than just knowing what things are going to do. Now, you can also, as a new investor and a trader, it's also important to know about cryptocurrency, because cryptocurrency also provides us some great benefits too. The thing with cryptocurrency is that it has a 4-year cycle, unlike the stock market with a 10-year cycle, its economic cycle, or the 1-year cycle. The cryptocurrency has a 4-year cycle. So every 4 years, we see record-breaking highs that are just amazing. Now the previous highs become the new lows. So we can see that since the existence of Bitcoin or cryptocurrency, now Bitcoin used to be under $1. I mean, it was like what, 10 cents, 25 cents, and then it just quickly surged up in that $10 range. And they're like, oh, it's too high. It's going to go down. Well. So the thing with the cycles is that it's called Bitcoin halving. That is a huge thing with Bitcoin, because the creator of Bitcoin wanted to always ensure that it was going to appreciate no matter what. But how do you get something that doesn't exist to appreciate? And he thought about it. He's thinking, okay, like gold or silver or diamonds, you're digging in the ground and eventually you run out. Then you have to dig another mine somewhere else, and eventually you run out, and you have low supply, high demand. But how do you do something like that with something digital that doesn't exist? So then one day he was like, aha, I got it. I'm going to create something that's called Bitcoin halving. It's going to take place every 4 years. And what happens is they subtract Bitcoin out of the system, but they leave the dollar amount there. So if they subtract half of the Bitcoin out of the system, but they leave the dollar amount in there, that means that the Bitcoin doubles itself. But then you have other people that want to take advantage of the opportunity, and they pour more money into the system. And so that way it then quadruples rather than doubles. But it doesn't take effect immediately after the halving event. It usually takes like maybe 6 months or so. And then all of a sudden, boom, it just skyrockets. Now, previously in the past, we've had new applications start to accept cryptocurrency as well as other states, because not all states are on board to be buying cryptocurrency. But as more states become more acceptable, there'll be more volume being poured into the system. So the last Bitcoin halving system, during the 2016 through 22, was pretty mellow after it had reached its $60,000 high mark, or no, it was a 18,000 dollar high, and then it kind of trickled back down to around the $3,000 low area, which is still a little higher than the previous highs before the last halving. And so now since the May of 2020, Bitcoin had surged up to about $60,000-$70,000. Okay, so now its midpoint around 40. Its low point is around, well, the previous highs, which is just around that $16,000, $17,000, $18,000 range. It's been hovering around $19,000 to $20,000 for quite a while now, but eventually it's going to skyrocket again. So the next Bitcoin halving event, you can see there, is early 2024. So we can really be prepared for that. And we could see other stocks, or not stocks, but other cryptocurrency, like because with what happened with Dogecoin, I don't know if you were around watching Dogecoin, how it was highly manipulated and it surged. I mean, it made people millionaires. But after it did what it did, there's usually a lot of copycats, just like GameStop, how AMC is a copycat. And there's several other copycats after that. But SHIB is the next copycat, and may also be the next Dogecoin coming into 2024. So a lot of people that put in maybe $20,000 into Dogecoin before it took off, after the last Bitcoin halving, that $20,000 would have gave you $1 million. So that is the next plan going into the next halving. Is we gotta go very heavy into SHIB and maybe several other ones, so that way we could take advantage of the next Bitcoin halving event. But just know that this is going to repeat itself every 4 years, just like clockwork. And a lot of times you'll see, and I'm going to show you something else here. We see this all the time. We'll see people saying, "Oh, it's dying." 2011, when it was like $1, now it went to a penny. Oh, it's dying. And then all of a sudden it did a Bitcoin halving, and it surged up a lot. And then it fell back to $200 in 2015. Everybody's, we should sell. It's dying. And then 2020, same thing. Like as I just mentioned, it reached down that $3,000 area once it was up to $16,000, $17,000, $18,000. And now we're going through the same exact thing where it was $60,000, $70,000 in the high. Now it's at the $20,000 range, and everybody's depressed and oh, it's dying. No, it's not. It's just chilling out for a little bit. 2025, look at this. So, and I believe if we do the math with this algorithm, Bitcoin will probably reach $240,000, and most likely, as we've seen with its normal algorithm, the previous highs become the new lows. So the lows will probably be like what, 60, 70, 80,000. I think 100,000 is probably a little too high for the lows. I'm thinking that it's going to be a little lower than that, but that is a great problem. I mean, this is history, and the amount of Bitcoin halvings that take place is to last, I think, over 100 years. There's only so many that they can do, but it's inevitable that Bitcoin will probably reach $1 million in what, 10, 15 years or so. It's not a matter of if, but when. It's inevitable for sure. So it's just good to know as a new investor how things work and how you can take advantage of it for your style of investing and trading, no matter whether it be cryptocurrency or stocks or stock options. Another way we can kind of, like I said, to forecast what the stock market is going to do in the long run is, like I said, we went over the quantitative tightening. That is another way to kind of look ahead to see when they're going to kind of slow down on that. Another way to kind of look at certain things is certain forecasts. I'm trying to find a certain forecast now, but I'm going to upload it here that we can guys take a look at it here. So this was brought to us by a long forecast, and so this I thought was a little bit more accurate, but it may be a little more volatile now. But it's a NASDAQ forecast month by month, and so but how we can kind of read this is, so I got this back in around August or July of 2020. So the total number down is the total number down of the NASDAQ based on whatever it was in July. So but by looking at it, we can kind of see what months may be kind of bearish or bullish, whether the number is lower or higher than the previous one, but also how low that it'll be, but also when we could start seeing that recovery. And again, as we were looking at the quantitative tightening, we can see that the last month for the quantitative tightening was the July, August, and September. So by looking at that, now we're using another source, we can see with this forecast here that the lowest point is pretty much going to be around that June, July area. Then after that, then the market begins to recover. September, it looks like we're up maybe 3%, and then October looks like we're up 1% from the difference there. Then November, we're up 4%. Then December, we're down 1%. Then going into 2024 for January, looks like we're up from there, then slightly down in February, but March, and it just keeps going up from there. So that is when we should expect the market to begin to recover. We're going to have a phenomenal bull season going into next spring or summer, as well as the fall should also be. So it's going to be a nice extended, bull season going into next year, but it's going to seem like it's going to take forever to get to that point. But like I said, it's just very important to really put a lot of these pieces of the puzzles together. That way it makes better sense of what type of investing and trading to do, whether you want to go long term on one account and do your short terms on another account. That way you can do your day trade, swing trading, and straddle. But yeah, it just ultimately depends on what you want to do.
Okay, yeah, thank you so much.
Yeah, what are your primary interests? Are you thinking short term, long term, or?
I'm thinking more like
long term.
because I know that I still Yeah, because I know I'm young now, and if I invest now and then just wait for the future, that'll all come right back to me. And I like to like be really, I want to be wise about how I do things, because I know kids my age, they spend, and never see money, and they go through that cycle. I have nothing.
Exactly. And it's good to have that entrepreneur mentality because a lot more than 99% of people, they get money and then they think, okay, where can I spend this now? No, we're like, we get money, now it's like, how can I invest this and double it now? That's us, that's what we do, and that this turns into our like self-employment. This is our job, this is our career, where again we can make $10,000 a day, $10,000 a week. It's unlimited. It has a great potential to the point where it's a much better job than anything else. And so a lot of people are afraid of that, but like I said, when you're making over $10,000 a day, I mean, it's like, dude. It is amazing, and there's so much you can do to help people. But it's important to know going long term, like you mentioned, that's your forte. But now we know what time of the year going into next year when you need to start investing heavy on stuff. But between now and next summer, because between now and next summer everything's just going to keep going down. But there may be some things that are flying under the radar. But how do we find those that are flying under the radar? And again, we always want to refer back to always follow the money. So if we go back to the stock options, so you being new, I don't know how long you've been in our live meeting here, but stock options, we have calls and then we have puts. So the calls is investors betting a stock goes up. A put is betting against the stock, betting it goes down. So when it comes to the volume is today's buying and selling activity, but open interest is the total of number of open option contracts that have been traded but not yet liquidated via an offsetting trades. That means investors bought it, but they're holding on to it. They haven't sold it yet. So those, for you being long term, that's what you want. So we want to click on open interest. We want to sort the whole thing out, refresh the page on barchart.com. That way it refreshes the whole entire system, sorting everything out by open interest. And what you want to do is you want to find, if you're looking to buy things to hold long term, we want to find the ones that people are buying now during their bear season, because these could be stocks that are flying under the radar. For example, Meta or Facebook, which is currently at $133 a share. That is extremely low. People are accumulating. They're buying now during this massive bear market because they absolutely believe and are betting that it's going to reach $420. I like that number, by the way. But it is very interesting how much of a difference that it is. I mean, you could easily gain 200% in a matter of a short period of time, and you're going to be very, very happy that you bought and held it, because these guys will too. And so most likely when Facebook gets up that high, they may do a split and everything and cause their price to go down and create more activity, and it'll become more valuable and everything. But again, Facebook is working on a lot of things. They're working on a whole new, phenomenal Oculus, the virtual reality thing. You don't even need the controls. It sees your hands, and I think it's going to have a new not a hologram thing, where it pulls your environment in your room or your house into the video, and it puts these holograms and stuff in there, kind of like the Microsoft HoloLens that never came out. But like I said, there's a lot of stuff being in the works, but again, follow the calls. Like Nikola, there's a $5 call strike. Well, I mean, this is not that long, it's about a month, but still, I mean, Nikola, maybe there could be some more new calls activity. If it does reach $5 by then, we could see $10 call strike prices. So to be determined, but you just have to know, these strike prices. Write them down on a trading journal or something. So that way you have a date of when to really kind of watch it to see, are there any changes? Are there a new strike price that's higher? or whatnot, you know. So, but yeah, I highly recommend doing this. You know, even Bed Bath and Beyond, you know, $5.42. That's too low for them. And like I said, with this being a holiday season, fourth quarter, retail does very, very well during the fourth quarter, but it doesn't reflect it until the first quarter when they announce the financial earnings. And so, and that's why we're seeing a January call strike price. So if it goes from $5 to even $40, I mean, you just gain like what, 300% in a very short period of time. And so, but this is your gold mine. I highly recommend that you bookmark this. If you're into long-term stuff, bookmark this, because you can come back to it every day and it changes, it updates. A lot of these guys will still stay there as they start coming down, like this here, Vail. This may disappear on the open interest tomorrow because it looks like they sold it. They bailed out of it because, you know, whatever reason, the strategy became invalid. Just like the differences between an amateur trader and a professional trader. We're just seeing it in the numbers here. So hopefully that makes sense. I know this has been a very long meeting. We've been at this for about 2.5 hours. We should cut it now. So thank you guys for showing up. We'll do this again next Sunday. Every Sunday we do this, but I'm still available 24/7 in our chat rooms. If you're not in our chat room, I definitely recommend that you do join our chat room. You just go to the top part of our Facebook group. There's a little menu icon in the top left. You click on there, and it has access to all sorts of live chat rooms and our live trading and which, you know, live trading, if you guys want to do live trading tomorrow morning during pre-market and during power hour, we can definitely do that. So, you know, just let me know. But yeah, I'm available 24/7. Thank you guys.